We're now going to move on to Chapter 7, Accounts Receivable and Notes Receivable. Now, normally when we talk about the term receivable, we're talking about that someone owes you money. And if they owe you money, normally from accounts receivable, that is generated by credit sales, where a customer buys something from you and, and they agree to pay you over time. The other type of receivable and notes receivable is when someone borrows money from you and you have them sign a document called a promissory note. The promissory note is a document that says that the maker of the note, which is the borrower, agrees to pay the lender a certain dollar amount plus interest. Now, this promissory note is a better document than an invoice in terms of validating the receivable amount because the borrower is signing their name to the document saying they agree to pay. Now, accounts receivable and notes receivable are both assets on the balance sheet because customers or borrowers agree that they are going to be paying you back. Unfortunately, for almost every business out there, there's going to be at some point in their business lives where a customer does not pay their receivable. In that event, we have to come up with both bad debt expense and the allowance for doubtful accounts. Now, in the prior lectures on accounts receivable, we talked about that there are two approaches to the creation or the recognition of bad debt expense. One was called the direct write-off approach, and the other one was called the allowance approach. The direct write-off approach is not generally accepted accounting principles, and we cannot use it for financial statement purposes because the direct write-off method basically says we don't recognize bad debt expenses until the invoice is truly gone bad and that we know we won't be able to collect on that accounts receivable. Because of generally accepted accounting principles, which is what we use to create our financial statements, we have to use the allowance method and the creation of the allowance for doubtful accounts for the recognition of bad debt expense. Because of the matching principle that we've talked about in earlier chapters, we recognize the bad debt expense in the same accounting period as the credit sale. Unfortunately, we make this credit sale, but we do not know at that time exactly which invoice will not be collectible. So therefore, when we recognize the bad debt expense at the time of the sale, we will create an allowance, as we call it, the allowance for doubtful accounts, and that allowance is somewhat like a pool of funds available to us to apply to potential bad debts that we may recognize in the future. By doing that, we are following the matching principle because now we're watching for bad debt expense in the same period as the revenue generated. Now, there's two approaches to the creation of bad debt expense in the allowance for doubtful accounts. One is called the income statement approach, and the other is called the balance sheet approach. The income statement approach is based upon coming up with a formula that basically says take your credit sales and multiply it times your bad debt rate, and what that gives you is your bad debt expense. So, your bad debt expense. Okay, it gives you your bad debt expense. That bad debt expense would therefore, we would do a debit to bad debt expense, credit to the allowance for doubtful accounts. Now, the balance sheet approach takes a little different look at it. Instead of looking at the credit sales, what we're going to look is the nature or the quality of the accounts receivables that are sitting in our financial statements. Now, those accounts receivables could be based upon, several customers or customers that could be good or they could be bad invoices holding them. So what we can do here is that we can look at the receivables, and if we have some sort of an approach that looks at the accounts receivable, what we can look is to basically say, take your accounts receivable balance times your bad debt rate, and what that will give us will be how much the allowance for doubtful accounts, how much that allowance for doubtful accounts should be. So what we have here is then if we have a T account, so let me draw a T account here for us real quick. Okay, so I have a T account here called the allowance for doubtful accounts. What I have here on my debit side and my credit side, the allowance for doubtful accounts is a contra asset account. And being a contra asset account, it means that its normal balance will be on the credit side of this T account. So our beginning balance will normally be on the credit side. Now, as we're going through and we're looking at the invoices that aren't collected over time during that period, when we want to take that accounts receivable off the books, we want to reduce the accounts receivable, and then the other side of the entry is the reduction for the allowance for doubtful accounts. So at the time of the write-off, we're going to debit the allowance for doubtful accounts, and we would debit accounts receivable. So we would reduce the accounts receivable. Now on the other side of this entry, the side that increases the allowance for doubtful accounts is the amount of bad debt expense that we're going to recognize in this current period. When we take all this together, we take the beginning balance plus the bad debt expense minus the write-offs for the period, we will get the ending allowance for doubtful accounts balance. This amount that has been determined as this allowance for doubtful accounts is this value, the ending balance for the allowance for doubtful accounts. So basically what we're doing is we're taking the accounts receivable balance times the rate to determine what the ending balance for the allowance for doubtful accounts should be, which is here. Once we know this amount, and we know how much we've done our write-off for, and we know how much our beginning balance for, we can determine how much the bad debt expense is going to be for the period in order to keep this equation in balance. So let's go and take some look at some problems and see if we can apply what we've just talked about. Let's look at the following exercise. At year-end, December 31st, Chan Company estimates its bad debt to be 0.5% of its annual credit sales of $975,000. Chan records his bad debt expense for that estimate. On the following February 1st, Chan decides that $580 of their customer, P Park, is uncollectible and writes it off as bad debt. On June 5th, Park unexpectedly pays the amount previously written off. So what they want us to do is to do the journal entry for December 31st, February 1st, and June 5th. So let's do this first entry, and this first entry for December 31st. Now on December 31st, we need to determine how much is our bad debt expense. Based upon this item right here where it says 0.5% of its annual credit sales. So what we have here is that our annual credit sales is $975,000. Our bad debt rate is 0.05%. So I'm going to put 0.05%, so that if I do the math and I take 975,000 times 0.05, I get 4,875. Now what we just said is if we multiply our bad debt rate against the credit sales, we are doing the income statement approach to determining bad debt expense. So this $4,875 is bad debt expense. Remember, when we're multiplying the rate times an income statement amount, the revenues, we get the bad debt expense. So our journal entry would be debit bad debt expense in the amount of $4,875. Then we need to do a credit to the allowance for doubtful accounts for $4,875. Okay, the next entry is for February. So on February 1st, it tells us here that on following February 1st, Chan decides that $580 account of P Park is uncollectible and writes it off as bad debt. So what we've done is we've already done the allowance for doubtful accounts. We've recognized the bad debt expense. Because we're doing the allowance method, we are not recognizing bad debt expense because of the write-off. Instead, what we're going to do is reduce the allowance for doubtful accounts for the amount of the invoice that we're writing off. So we have to do a reduction to the allowance for doubtful accounts. So we're going to debit allowance. And it's in the amount of $580. And the corresponding credit is to accounts receivable for $580. That's how we do a write-off. So if we're doing a T account here, let me draw a T account. And let me give me a little more space here. And let's draw another one here. Okay, so what we have here is the allowance for doubtful account. And over here, we have our bad debt expense. And maybe we should do one more. And this is accounts receivable. Okay, so what we've got here is originally we had a debit to bad debt expense for $48.75, credit the allowance for doubtful accounts for $48.75, which is this entry right here. Then at the time of doing the write-off, we're going to reduce the allowance for doubtful accounts by $580. and we're going to reduce accounts receivables by $580. Okay, so now what happened is that on June 5th, Park unexpectedly pays the amount previously written off. So Park ends up sending us a check for $580. Unfortunately, the problem is that we've taken this $580 off the books. So in order to take the cash in that we're about to receive from Park, what we need to do is we need to put the $580 back into accounts receivable. So what we have to do is this journal entry on February 1st has to be reversed. So we're going to debit accounts receivable. For $580, we're going to credit the allowance for doubtful accounts for $580. Now that the 580 is back, because what we've basically done is taken a debit to 580 here, and we've done a debit to 580 here. So basically what we've done is we've crossed out or canceled out the two 580s here, and we've canceled out the write-off of the 580 here. So now we have $580 back on the books. So now we can receive the cash for $580, and we can reduce the receivable for $580. Okay, so that's the entry on June 5th. All right, so that's basically all it takes. It's pretty simple. The recognition of the bad debt expense, recognition of the write-off, recognition of the cash received where we had to reverse the write-off in order to collect cash. Okay, so now let's take another problem that takes a look at the allowance for doubtful accounts. This next exercise is based upon the accounts receivable or balance sheet method in order to determine the allowance for doubtful accounts. Now remember what we talked about in earlier discussions about the allowance for doubtful accounts. In terms of the components that go into this T account, we have our beginning balance, which because this is a normal balance of a credit for the allowance for doubtful accounts because it is a contra asset account, that the increases to the contra asset account are going to be the bad debt expense, and the decreases to this account are going to be the write-offs to accounts receivable, which are the invoices that we've identified as being uncollectible. When we take the difference between the debits and the credits, we will get what we have the ending balance in our accounts receivable. Now remember, the income statement approach said we multiplied our bad debt rate against credit sales and it gave us bad debt expense. Now we're going to take a different approach by saying, let's take a look at the accounts receivable balance, multiply it against the bad debt rate, and what we're going to get is we're going to get the ending balance amount for the allowance for doubtful accounts. So let's take a look at Booyah Supply Company. Over here it says that the company uses percent of accounts receivable method to estimate its bad debts. On December 31st, 2008, it has an outstanding accounts receivable balance of $55,000, and it estimates that 2% will be uncollectible. So, if I take my ending accounts receivable balance, which is going to be $55,000, and I'm going to take my bad debt rate, and that bad debt rate is 2% or 0.02. If I multiply the two out, I'm going to get my ending allowance for doubtful accounts. And so what I'm going to do is I'm going to say, from an equation standpoint, take my $55,000 times 2% to give me my balance should be $1,100. So in essence, what I'm saying here, if I start with a $415 credit balance before the adjustment over here, and I have to have $1,100 here as my ending balance. So the question then is, what do I have to put here as my bad debt expense in order to get to the $1,100? So I could create an equation that said take my ending balance minus the $415 credit balance. And so I need to have $685 in bad debt expense in order to create $1,100 in the ending allowance for doubtful accounts. So our journal entry would be debit bad debt expense for $685 and credit the allowance for doubtful accounts for $685. So this is the journal entry that you'd have to do for Part A. Now Part B says, what if you had a $291 debit balance before the adjustment? The question then is, how could we get $291 on the debit side of a credit balance account? Now remember, if we started with a beginning balance and we wrote off accounts receivable through the period, if we wrote off more than what was available in the beginning balance, we're going to end up with a debit balance over here in the allowance for doubtful accounts. Now, based upon this calculation, we're still saying that the balance should be $1,100 for the ending balance for the allowance. So the question then is, how much do we have to credit in the allowance for doubtful accounts in order to get $1,100 in the allowance account? Remember, this is on the other side, so we need to make sure that the credit entry is going to be big enough that when we subtract out the $291, we're going to get the $1,100. So we could create an equation that says take our $1,100 and we're going to need to add in the $291. So we're going to need $1,391 on the credit side in order to get $1,100 as our ending balance. So our journal entry, debit bad debt expense for $1,391. We want to credit the allowance for doubtful accounts for $1,391. So that's the journal entry. When we basically use the accounts receivable method in order to determine how much we should have in our ending allowance for doubtful accounts. Not too bad. So let's do this. Let's do a kind of a little more complicated problem that tries to bring this all together. Our last problem that we're going to do for this chapter is taking a look at all the journal entries that we have to make when we recognize the accounts receivable because of a credit sale, to the recognition of the bad debt expense and the corresponding journal entries that we might have to make. So the very first thing that we want to do is let's first take a look at 2007 for Liang Company when they began operations in 2007. During its first 2 years, the company completed a number of transactions and for both receivable credit sales, receivable collections, and bad debts. So what's the journal entries that we have to make? So the very first entry says they sold $1,345,400 worth of merchandise at a cost of $975,000. Typically, if you see a problem like this, when they give you the cost, the assumption is that they're using the perpetual inventory method. So what we need to do is we need to do a journal entry that recognizes that we have sold $1,345,400 in merchandise. So we're going to debit accounts receivable, and it's going to be for the $1,345,400, and we're going to credit sales for the same amount, $1,345,400. So what we've just done is we've recognized the increase to accounts receivable, but we've also increased the amount of the sales for the year 2007. But because the cost of $975,000, we have to recognize the cost of goods sold. Now remember, cost of goods sold is an expense. Being an expense, it increases with the debit entry. So we're going to debit $975,000 to recognize the cost of the inventory that corresponds to this $1,345,400 in sales. So then, after we recognize the cost of goods sold, we have to reduce what we sold, which is the merchandise inventory. For the same amount. Okay, then so what we have done right now is that we've increased the accounts receivable by $1,345,400. Now here it says they write off $18,300 of uncollectible accounts receivable. So what they've done is they need to take $18,300 worth of accounts receivable off the books. Now, if we're doing the allowance method, what we have to do is reduce the allowance. And it's because the allowance method is a credit balance account, we need to debit the allowance. For the amount of $18,300, and because this is a write-off, we're going to take out the amounts out of accounts receivable. Okay, so what we've just done here is we're reducing accounts receivable by $18,300, and we're reducing the allowance by $18,300. Okay, the next one, C, says we receive $669,200 in cash and payments for the accounts receivable. So this journal entry needs to reflect that we received cash, so cash is going to go up by $669,200, and accounts receivable is going to go down by that amount because the customers no longer owe us the money. So now what we have here is a credit to accounts receivable of $669,200. And then it says, in adjusting the accounts on December 31st, the company estimates that 1.5% of the accounts receivable will be uncollectible. So in other words, what we're saying here is that we need to look at the accounts receivable. So if we need to determine the accounts receivable balance, we could have said, take your debit entries, which would be your credit sales of $1,345,400, subtract, and then we want to take a look at the $18,300, which are write-offs. Which were $18,300, which is my credit entry, plus my cash from your customers in payment of your accounts receivable of $669,200. So what ends up is that our ending accounts receivable balance is the $1,345,400 minus the $18,300 minus the $669,200. So our ending balance is $657,900. Now, if we take our bad debt rate, and that bad debt rate was 1.5%, so 0.015, what that will give us is that will be our required ending allowance. So I want to take the 657,900 times the 0.015. So we should have a required allowance for doubtful accounts over here of $9,868.50. So what we're saying is that we already have a debit balance. We have a debit balance here. So take your debit allowance balance of $18,300. So our bad debt expense adjustment is going to be take your $9,868.50 plus your $18,300. So I would need to do a journal entry for letter D, which is debit bad debt expense. And we'll round this to 28,169. Credit the allowance for doubtful accounts of 28,169. Okay, so what we're doing here is that we're going to do a credit balance entry here of 28,169 to reflect our increase, so that we can make sure that we have $9,869 over here in the allowance for doubtful accounts. Now, because these two are permanent accounts, at the end of the year, these balances are going to carry over into the next year. So if I wanted to take a total, what are my ending accounts receivable? We figured out my ending accounts receivable amount was going to be $657,900, and it's going to be a debit balance. So I'm going to put over here at my beginning so we'll know what we're starting with. And my allowance for doubtful accounts is going to be $9,869. Okay, so now this is our new year with our beginning balances. So let me get rid of all this here so we have some room to write. So now I can do the journal entries again. And the journal entry is just like in the prior year. We sell $1,525,600 worth of merchandise. So debit accounts receivable. For $1,525,600. Credit sales for $1,525,600. Recognize the cost of goods sold. So debit cost of goods sold. And they tell you its value is $1,250,000. Credit merchandise inventory. For $1,250,000. Okay. Next, we write off $27,800. So what I'm going to do is debit the allowance for doubtful accounts, and we're going to do a write-off of $27,800. If we do the write-off, we're going to reduce the accounts receivable for the same amount. Now then, entry G, we're going to recognize the cash we received. We debit cash because cash is going to go up because we received 1,204,600, and that's going to reduce accounts receivable for 1,204,600. And then finally, the last thing again is just to do the journal entry. So what I can do is I can go look at my entries that I've made and post those up, and then I'm going to increase my accounts receivable balance by 1,525,600. Then the next entry over here, we're going to recognize the write-off. We're going to reduce the allowance by 27,800. Then here we receive the cash, so we're going to reduce the accounts receivable balance of 1,204,600. So once again, we can do the math. I'll let you do this on your own, but basically what your check value should be is that you need to make a journal entry, and you'll need to determine how we got there, of debit to bad debt expense, just like before. And they'll give you your check number, $32,198. We're going to credit the allowance account for doubtful accounts. And that's also for $32,198. What I want to do is I want to leave you with that this is our entry that goes here. So how did we get the allowance for doubtful accounts ending balance? You do it the exact same way as we did it in 2007. Let me make that as your challenge to make sure that you've understood the concepts for this chapter. So hopefully this will help, and we'll see you in the next chapter.